And now, fans, let's welcome back on the harmonica, Mr. Jimmy Sengenberger.
Welcome back to Jimmy at the Crossroads, the only political and economics show and podcast where you will find your host playing his own bumper music, coming back on the harmonica, coming to you in partnership with the Washington Examiner. And I am so pleased to welcome to Jimmy at the Crossroads someone who I know enjoys the harmonica because he's a fan of Blues Traveler like I am. Now, that was no John Popper style playing, but we'll see what he thinks. I'm pleased to welcome to Jimmy at the Crossroads, the CEO of Dynamic Money, as we dive in to economics, markets, and more, Chris Burns. Chris, my friend, welcome to the show. Good to have you here.
Jimmy, thank you so much. It's hard to follow up on the former president and then have you on the harmonica, but I'll do my best.
You know, I thought I'd make it very difficult for you with the hotline phone call from Bill Clinton praising yours truly and then playing a little harmonica. Now, there was no John Popper playing, but was it all right?
Oh, man, it was fantastic. Well, it was better than my harmonica playing. So, and that's
I don't think that's saying much, though.
The high standard.
Yeah,
we'll see.
Exactly.
We'll see.
Good to have you here. How are you doing amidst everything?
I'm okay. Thank you for your patience. We've tried to do this 4 or 5 times, and every time something seems to happen. So awesome to be on your new show. Neat to see your success in the midst of, honestly, just so much craziness for so many people right now. So it's a weird time to launch on the one hand, but on the other hand, I think there's a lot of people looking for just good content, and I'm just excited to see what you're doing.
I appreciate that, Chris. Thank you so much. So tell us a little bit more about yourself, because you have a background in markets and investing. Tell us about what's going on with Dynamic Money. You're also a radio host who hosts finance media programming. So who is Chris Burns? What do you do?
Yeah, right now I take care of kids a lot. Actually, it's been an interesting situation the last few weeks as we've all transitioned home. But most of the time, so I run Dynamic Money, which is a fee-only financial planning firm, and that sounds like a lot of random language, but it basically just means we don't take commissions on anything. And so we charge a fee for helping people do planning, and then we charge a fee if we manage their investments. To try to be as objective as we can as we give people advice. And the other side of that's the broadcast side. And you're right, I have the Chris Burns Show on WSB, which is a station in Atlanta, but you can hear it on the Chris Burns Show on the podcast. And then I jump on with folks like you whenever I can.
So we've been seeing quite a topsy-turvy market, and it's probably an understatement to put it that way. Significant declines, but yesterday we were up, 7% or so on the stock market. The Dow was up 1,600 points. Today we're up several hundred as we talk right now. What do you make of the market dynamics that we're seeing? I mean, there's a lot of volatility, and then when we see the swings upward or downward, they don't seem to be very small. They're at least several hundred points, if not 1,000 or more, upward or downward.
Yeah, one thing that encourages me is a string of days. Anything that we see that shows volatility is changing. And like you just said, the point you made is actually critical here. If the market's dropping significantly, and then it goes up significantly, both of those are actually concerning to me because I'm looking at volatility itself as the concern. And even though nobody calls you and is angry if their portfolio goes up 10%, that can be problematic if we're seeing massive swings. It's kind of like watching Bitcoin a few years ago. And so I would just say right now, the reason the market's responding well is that preliminary data is showing this shelter-in-place concept is working across much of the world. There's a lot of hope that we're going to see this be, we're going to have an effective conclusion to this. that does not go hand in hand necessarily with an easy walk back out of the economic reality this has created. And it's important to remember the difference between the markets going up and what the economy is doing.
That is an important distinction because they don't always go in tandem. In fact, we may not see some of the cratering of the market take place until probably once we get even second quarter data. I mean, it is the case that you learn more about the underlying strengths and weaknesses of a company whenever earnings come in during earnings season. And then that can tell you, okay, are these companies, were they able to survive? How well were they able to survive? What's next coming up on the horizon? So this will be a very interesting, once we get later on into the second quarter and get to earnings season for the second quarter, it'll be interesting to see what happens.
Yeah, we've seen some staggering numbers, and they're just things that we should be sitting back and going, where is this going to take us? Nobody knows that, but it's good to have that long-term mentality. So for instance, the incredible spike, obviously, in unemployment numbers is huge, and it's impacting regular people right now who are trying to figure this out. But for instance, in the last half of March, we saw almost a 2,000% increase in mortgage forbearance requests, a 2,000% increase in 2 weeks. And so you go, okay, no one's really talking about real estate right now, for instance, which is a massive part of the wealth of our country. It's a huge part of our economic stability. And yet, what is the impact when you have millions of people laid off, and then we see the corresponding massive increase and concern over whether they can pay their mortgages or not? What happens when those foreclosures suddenly open up, if that comes to be, if the government allows that to happen on the economy? So there's a lot of things like that, like you said, numbers that we're seeing the first signs of those numbers, but we really don't have the long-term view yet. And it just tells us we have a ways to get out of the woods here.
Again, we're talking with Chris Burns, CEO of Dynamic Money. And Chris, I'm curious your thoughts on federal government policies of late. I mean, I am aghast at the $2 trillion stimulus package, more than $4 trillion also provided from an authority to the Federal Reserve as far as liquidity. Now, I get some of these things are necessary. I can see some of the components of the legislation make sense to me in terms of providing support for various businesses and also providing support for people who are out of work. It's how you go about it that matters to me, but also we have the Fed implementing new tools and policies that maybe they haven't even done before. So what do you make of that and how that may be impacting investors' mindsets right now?
Yeah, that's a great point. So basically, the last part of what you just said is what concerns me the most, is that the Fed is doing everything they can to be creative, which on the one hand, I go, great, we need creativity, the scale, the scope, the intensity of this economic crash, in essence, what we're experiencing right now, is somewhat unprecedented, certainly in our lifetimes. And so in that sense, great. I'm happy that we have creativity, but the reality is the Fed's doing a lot of things that they've never done before, like you said, and we don't then have a template for how that plays out over time. The number one thing the Fed would normally do, what most people know about the Fed is, well, they would lower interest rates to stimulate the economy. That's just like the tip of the iceberg here. But the reality is we were lowering interest rates when the economy was the best it's ever been, or certainly the best it's been for a decade. And so we took away the easy options we had for stimulating the economy almost immediately. And now we're sitting here making up ways of doing that for, it just seems like an unlimited Amex, basically. Just keep swiping and we'll keep figuring out how to pay for it.
Well, I would say this about the Fed. I mean, first of all, I think that the Fed's ability to influence the economy, particularly with interest rates and also quantitative easing, which they're bringing back too, is overrated and overstated. However, to the extent that they do have an impact, I know last year, and you and I had talked about this on the radio, I had been saying, look, the Fed, if they really want to be able to have a maximum impact when we do have the next downturn, they shouldn't be cutting rates now, yet they were. They were making that decision, and they stopped rolling down their balance sheet, which was trillions of dollars amassed in the aftermath of the Great Recession because of the quantitative easing policies. And I was saying, again, you should be continuing the rollback because once we do actually hit an economic malaise, If you think that quantitative easing is going to have an impact, well, then maybe it would be a little bit more so then. I mean, I'm a believer that quantitative easing didn't work before, but if you believe that it did,
Right.
you should at least want to have some arrows in your quiver. And yet, here we are now. They've spent those arrows, and you're wondering, okay, what can you do now to the extent they can make an impact?
Yeah, and so now they're pouring trillions into programs that most people have never heard of or understood. I mean, if you actually, there's the Brookings Institution has a great website you can go to. Or if you just Google, for instance, what is the Fed doing based on the coronavirus, you're going to get pages and pages of the programs they're implementing that most Americans have never heard anything about or have any clue about. And so it's very hard for most people to sit and go, I like this or I don't like this, because they don't even know what's going on, honestly, with the Fed. But the Fed's doing everything they can to keep markets functioning in some sort of normal sense and keep credit flowing so that banks have credit to lend out. That's the theory. But it's all happening so fast and it's all new programming. So we have no idea what the impact is, except for that on the other side of this, we're going to have a massive amount of increased debt, basically, because we took on so much trying to deal with this. And everybody's so focused right now on saying we need to give every resource possible to this problem. Well, I don't disagree with that. Look, my sister-in-law is a nurse in California right now. I understand how intense this is and it needs to be given resources. But I think we're seeing the impact of not thinking about it in the years of plenty. It's almost like going back to Sunday school and talking about Joseph, of like, you store up in the good years so that in the bad years you have something to rely on. What we're seeing right now is we didn't have anything to fall back on. And so we're just trying to create it in the moment. And being reactive is always painful long term.
Well, one thing to keep in mind, Chris Burns, is that we were already talking about the concern of corporate debt. And now you're adding on more of that corporate debt. And only portions of the loans that the Small Business Administration is giving out or the federal government is giving out that are allocated specifically towards employees, keeping workers on the payroll, that portion will be forgiven by the government. But everything else, anything else that you're getting these loans out for, isn't going to be forgiven by the federal government. So you will be adding to corporate debt. You will be adding to the debt of small business owners and so forth that are going to be coming out of this already wondering, am I going to be able to recoup revenue in the first place, let alone pay down my debt? And so that's certainly a very important component. The question is, to what extent, as we are seeing these programs roll out very quickly, as you were pointing out, Chris Burns, to what extent will the speed of these policies and programs and the number of them cause more problems economically than otherwise? Because if you think about it, when the government implements a new program, that already is going to have effects. But when people are trying to sift through and figure out what's the best program, what's the best loan offering, what's the best opportunity that the federal government or the Fed is now providing that I can take advantage of, trying to sift through that and then consider all of the effects, second and third order effects too, that will come from that, it's going to be a headache at a minimum.
Oh, yeah. I mean, well, think about it in even this basic of terms. Right now, part of the CARES Act was loosening up, and this just takes it down to every person listening, or most people listening right now to this, can identify with this, right? If you have a 401k, it's very hard to get money out of it. You can take a loan on it, and there's strengths and weaknesses to that, more weaknesses than strengths, but most of the time it's supposed to be set aside for the future. Well, the CARES Act says, which is the stimulus, the first package passed, said, hey, look, you can take an actual coronavirus distribution for up to $100,000 with very few of the penalties associated that you would have had in a normal situation, which sounds great in terms of some people specifically really need that right now to be okay. And I don't downplay that. But it also means that a lot of people are going to be taking money out because there's an opportunity to do so. And then you look at the ripple effects over 10, 20, 30 years. If I chose to take a big chunk of money out and it never had that compounding interest, when I'm relying on that for retirement. And again, no one's thinking that way because we're sitting and dealing with this immediate thing in front of us. And when you're dealing with a crisis right in front of you and you don't have easy resources to handle it, then you go, I'll worry about the long term later. But you're exactly right that the long term impact of not just that program, but that times 1,000, all the different things that we're doing right now to try to curb this, it will have implications for people down the road. And so everyone should be thinking, just because this is available to me, is this good for me? And that's really the critical question.
Absolutely. Again, Chris Burns, our guest, CEO of Dynamic Money. One more policy thing, and then I want to get back to the stock market, and that is tariffs. The trade war with China is technically, like, I don't know if you want to call it a truce or over. I think it's more of a truce because we still have tariffs that are in place with the phase one deal. That's more of a truce sort of arrangement between the United States and China. But there are still a heck of a lot of tariffs that are in place. And General Motors is one of those companies that President Trump has now ordered to produce PPE to be able to provide, and other technologies to be able to provide support to physicians, to medical personnel across the country trying to address this crisis. Well, General Motors said late last week to the Trump administration, hey, we need you to cut tariffs on some of the components that we need in order to make ventilators. Now, the Trump administration, I don't think, has reached a decision on that at this point, but it really goes to show the negative impacts of engaging in a trade war and putting tariffs in place, particularly because, look, we may be trying to manufacture these products here, all well and good in order to address a crisis. But at the same time, goods do come from other parts of the world in order to make the component parts and build up these products that are needed, these goods that are needed to help address the crisis. So what are your thoughts on that wrinkle here?
Well, I tend to agree with you. I don't like tariffs in general. I'm a libertarian bent there. And honestly, this president has been on the far other side of utilizing tariffs in every situation or as often as possible. I almost feel like people are let down at this point. Countries feel like they're not close to us if they haven't gotten tariffs because all of our allies have had so many tariffs. But anyway, the interesting thing about GE in this and in that whole question is that GM, I'm sorry, I'm losing it. Lighthizer had come out. So the president's primary trade negotiator had come out and said, hey, look, we've already, we don't have tariffs on nebulizers, for instance, or on ventilators. But GM's coming back and saying, hey, look, no, you might not have tariffs on the completed product, but if we're going to make them in the States, there's tariffs on the different pieces we need to make these. And that's where the White House hasn't come back yet. So I think that's where we really see politics coming into this. And I agree with your take on tariffs. But across the board, I mean, even if you go back to why is it that we had seen such a push to decrease interest rates by the Fed even months ago when the economy was great, it was because the White House was pushing and saying, I mean, literally, I think that, Jerome Powell was public enemy number one, the chairman of the Fed, because he wouldn't push down rates more at that point. And so that's where the intersection of politics and economics can be really troubling. And I agree, this is one area where the government needs to step back quickly to make sure we can be in a good position.
Well, here on Jimmy at the Crossroads, we are at where politics and economics collide. So very well put, Chris Burns. So let's shift back to the stock market. Given everything that we're seeing in terms of policies and in terms of the fact that we're still at a shutdown and 29% of the economy, one source, I don't remember if it's the Fed or one of the banks, said that 29% of the economy at this point is basically just completely shut down because of what we're seeing with all these anti-coronavirus policies to combat the spread and flatten the curve. And with all of that in mind, how do you think investors should be thinking and preparing for this market climate? Because I don't think the volatility is going to go anywhere anytime soon. I don't think we're going to see a massive uptick anytime soon in terms of the stock market, but maybe we'll go down more or what have you. I mean, obviously we can't project what the future will have in store, but what should investors keep in mind in order to prepare?
Yeah, so there's two parallel realities in my mind that are both true, and it's maddening, okay? So the one is, especially for younger investors, there may never be a time in your life that's better to invest because so many strong companies that we don't expect are going to fail are significantly down right now. So that's what you hear a lot of people talking about, that now is a great time to invest. And mathematically, that's true. But the reality on the flip side, which is just as true, is that a lot of people right now are sitting out there, and I meet with them all the time, both in their 20s and in their 50s, that have a ton of money sitting in their 401k or in IRAs and literally no emergency funds, no safety money. And there's never been a more important time to have a cushion because so much is unknown. So I think people need to come to terms with a few things. One, there's going to be time here. This is a lengthy process we're going to experience. It's not something that's going to be done in the next few weeks. And so understand you're in this for a bit of the long haul. And as good as it could be mathematically for you, if you have the ability to put money into the market right now, because long term you're going to see that grow, you have to put your personal safety, your family being okay before that. And so it might mean that you miss out on some opportunities. It might mean stopping contributing to a 401k so that you build your emergency funds. It might be paying the minimum on your debts right now, again, just so you have more cash in hand. People need to be thinking liquidity right now. And then if you're blessed enough to be in a position where you can put money in the market, just diversify well. That will blow up over time.
Chris Burns, and I think you kind of touched on this a little bit there in your last answer, but what do you think people should keep in mind about what not to do at this juncture, which I think is as important, if not more important, than what to do?
That's a great point, because a lot of calls that I'm getting right now are actually, you have a portion of people calling that are worried about the market. And so it's, should I get out right now? And everybody's heard that answer. Be really careful about getting out, because in essence, you are taking, you're selling your stocks for a significant hit at that point. It's like a garage sale. You don't want to do that. You might need to reduce your risk somewhat, but you don't want to do it by going all to cash. But I'm getting just as many calls, and this is the more interesting side, from people going, okay, where should I be throwing this extra money I have? And they don't have a lot of extra money, but they basically are viewing this somewhat almost like the lottery. It's like, hey, look, there's opportunity right now. I think these stocks are going to come back. People that never talk to me about the market are reaching out and saying, what do you think of this company? Or should I be looking at this company to invest in? And I would say that's just as dangerous. You have to have your fundamentals in order. You have to have money saved, and you have to be putting money into well-diversified long-term funds like a 401k or an IRA before you take a huge chunk of your extra money right now and just throw it into a company because your best friend's neighbor's dog said it was going to blow up because of the crisis. There's a real danger for a lot of people in throwing extra money into something they have no expertise in because they're hoping for a get rich quick type scenario. So both sides are dangerous.
I have to say that I always encourage viewers and listeners to talk to a financial advisor, not their friend's neighbor's dog, before making a decision on how to go ahead and invest your money. Just a final question for you, Chris Burns, again, CEO of Dynamic Money. When it comes to the economic climate today, I mean, obviously, as we were talking about, so much is politically driven with different policies that are put into place, but also we have the markets that are watching headlines and seeing what's happening with the economy and seeing what's happening with the politics and the policies. The big question that I like talking with investing experts about is how to approach the headlines. When you see a headline that's disturbing or a headline that's encouraging, how quickly should you be to react to that particular headline, or how deeply should you go underneath the hood before making, or into the details of the story before making a decision?
Yeah, this is one area where you have to be super careful and just remember, and you're in this business too, Jimmy. So the reality is everybody wants a large following, and certainly the same is true for the largest TV station networks, cable networks, newspapers, etc. You're not going to get headlines by saying market up, but don't get too excited, right? You're going to get market has breakthrough day or breakthrough week, and it looks like, and you read that article, and even if you go into the depth of the article, sometimes it sounds like, hey, listen, everything's coming back. Maybe we're going to be in a good position for a lot of things I've seen. Or it's the opposite. It's financial Armageddon and the world's going to end. And I would just say, be really, just remind yourself constantly that these companies are doing everything possible just to get their share of the viewership. And so that means extreme and exaggerated is going to sell more than just saying the actual reality. The reality right now is most of us don't know exactly what's coming. Well, none of us know exactly what's coming. And most of us are sitting every day and watching what's going on in the markets. And if we're going to be honest with ourselves, we don't know how long this is going to last. We don't know how long the economic reality or the long-term ripples of the economic reality. So let's keep that in our minds as we read the paper every day. If
Very
we
well
read the
put.
paper, I don't
Yeah,
know.
I don't know. I certainly
Yeah,
read the
okay.
Washington Examiner online, and they have a magazine, by the way. So, Chris Burns,
Yes.
I got to give you a little outro. Let me just. How's that?
Seamless transition.
I
Seamless.
think sometimes, look, when we do this on Jimmy at the Crossroads, you got to have a little bit of fun with all the tension going on. You have to cut loose a little bit and sometimes blow on that harp.
It helps it out, man.
All right, Chris Burns, CEO of Dynamic Money. Thanks so much for joining us. Great to have you. We will have you back soon, I'm sure.
Hey, thanks, Jimmy. I appreciate it.
Thank you. We appreciate it as well. Once again, Chris Burns, Dynamic Money, always great insights. Joining us here on Jimmy at the Crossroads in partnership with the Washington Examiner.